About 1 in 2 American households invest in mutual funds, and in the US alone, the combined assets of mutual funds total about $30 trillion. And yet, most of us regular people don't even know what mutual funds actually are. So in this video, I'll teach you what mutual funds are, how they work, and whether they belong in your investment portfolio. Simply, a mutual fund is a managed fund where shareholders pool their money to collectively invest in securities like stocks, bonds, etc. By investing in a mutual fund, you're basically putting your money in the hands of the mutual fund manager, and then they make investment decisions on your behalf and on behalf of all the other shareholders who have also contributed. And then when those investments grow in value or pay out dividends, that's distributed in proportion to each shareholder's contributions. Each mutual fund will also have a stated objective so that you know what the goal of the fund manager is with your money. And since mutual funds require management, they automatically deduct a fee from your investment, and that fee is known as the expense ratio. The more actively managed that a mutual fund is, the higher the expense ratio has to be because it's more work for management. And generally, expense ratios of mutual funds will vary from 0.05 to 1.5%. Unlike ETFs that can be bought and sold on the stock market just like a regular company's stock, mutual funds can only be bought or sold after the market closes when they're priced for the day based on their net asset value, their NAV, minus their expenses and divided by the total number of shares. Some mutual funds will also have minimum investment requirements while others won't, and most Americans generally choose to invest in mutual funds through their employer retirement plans like 401ks because mutual funds are professionally managed and because they allow the investor to instantly diversify across many different securities and sectors of the economy without too much upfront money or risk. An interesting type of mutual fund that you might want to consider is a target date fund, where the fund manager considers the year that you would like to retire as an investor, and these mutual funds usually have the year, such as 2050 or 2075, included in their names. And basically what they do is they actively manage the funds such that they start out with a very aggressive growth strategy and then switch to a more conservative strategy as your retirement date nears. There are also tons of other kinds of mutual funds, such as index mutual funds, income funds, sector funds, and many more. But before you go and potentially invest in any of those, let's look at the downsides that mutual funds tend to have. The downsides of any particular mutual fund may include minimum investment requirements, less flexible trading, high expense ratios, poor management and thus performance, and tax disadvantages because the manager might be selling securities and that can trigger capital gains taxes that can then be passed on to you even if you're not buying and selling your shares of the mutual fund. To avoid these downsides, I personally advise beginners to invest in ETFs rather than mutual funds, and here's my reasons why. ETFs do not have minimum investment requirements. They have more flexible trading as you can trade them throughout the stock market day, and ETFs tend to have lower expense ratios. Poor management can also be mitigated by buying passively managed index ETFs that have a strong history of good performance like the S&P 500. And lastly, ETFs are tax advantaged because they have a creation and redemption mechanism that works in the background that mutual funds lack. There are some other slight differences between mutual funds and ETFs, but they're honestly very nominal and they're beyond the scope of this video. So in my opinion, most beginners, when given the option, should just stick to ETFs, but you can do more research if you would like. To recap, mutual funds are managed funds where shareholders pool their money together to collectively invest in securities like stocks and bonds. And many Americans invest in mutual funds because they're professionally managed and because they usually offer broad diversification. Index ETFs are a strong competitor to mutual funds because of their many advantages, but like I said, mutual funds do have some nominal advantages of their own, so exploring the differences between the two is probably a good idea before you go and invest heavily into either one or the other. If you found this lesson insightful, I'd really appreciate it if you go and invest in that like button, consider subscribing to the channel, check out these videos for more.